So, what is an ISA? An ISA, or individual savings account, is a type of account which allows UK residents to either save or invest in a manner which is tax efficient. Individuals can contribute into this account from either their surplus income or any cash windfalls they have received. As the name suggests, you're able to contribute to this type of account through personal wealth only, not wealth held in a limited business. The benefit of utilising an ISA is that investment gains or interest earned in the account is tax-free. Plus, you'll be able to withdraw your money from your ISA in the future with no age restrictions and without incurring tax. You're able to contribute into this account on a regular or lump sum basis, and the amount you're able to contribute is limited by the ISA allowance. This is determined by HMRC. This allowance refreshes on the 6th of April each year, giving someone the opportunity to continue saving or investing in this tax-efficient manner annually. There are two main types of ISA to consider using, and these are the cash ISA and stocks and shares ISA. Cash ISAs earn interest, whereas stocks and shares ISAs allow you to invest in a wide range of funds or other types of investments to hopefully achieve investment growth. But remember, this does take on investment risk. You can pay into either of these ISAs in the same tax year, but importantly, the total amount you pay into the ISAs combined cannot exceed the ISA allowance. So why should you consider an ISA? Well, an ISA is one of the few means in which a person can save or invest money and have the growth and future withdrawals made within the product be tax-free. So if you are in a position to save some of your surplus wealth, utilising some or all of your ISA allowance is a great starting place for most people. So, you may be wondering which type of ISA is suitable for me. The type of ISA to use will largely depend on your financial objectives and appetite for investment risk. Broadly speaking, cash ISAs are considered lower risk and are typically better if you are saving for less than 5 years, do not want to risk losing money because of investment risk, or you might need to take money out at short notice. Stocks and shares ISA are considered higher risks and are typically better if you are saving for more than 5 years and are comfortable with the idea that you may lose some of the value of your ISA due to investment market movements.